Yeah, so you are so much welcome to the class. We can actually proceed from where we left in our previous class. We were looking at the topic of leases, the subtopic of leases, which is under topic number 1, assets and liabilities. So we have already covered how you can be able to deal with accounting for the leases in the books of the LAC, and where we are talking about where the lease payments are being done in arrears, So today, I want us now we look at how you can be able to account for leases in the books of the lessee, where the lease payments are being done in advance, where the lease payments are being done in advance, where the lease payments are being done in advance. Of course, I was able to indicate to you, under a lease agreement or a lease contract, there are usually two parties. We have the lessor and we have the lessee. The lessor is the one who's having to convey the right of use of an asset to the lessee. So if you are looking at the relationship here, I was having to relate it, or it is just similar to what we refer to as a landlord and a tenant. So the landlord conveys the right of use of the asset to the tenant, or the lessor conveys the right of use of the asset to the lessee. So what is so much common in the exam, what they'll end up having to test you on in financial reporting, is actually how you account for leases in the books of the lessee. And of course, we said when you're looking at how the lessee will be able to account for leases in these books of accounts, there are key items you must actually be able to compute. We have what we call the right of use of the asset, what we call ROA. There are these 3 key items. ROA has to be computed. Then, of course, number 2, you have to also ascertain what's depreciation on ROA. ROA simply means right of use of an asset. There's a way we compute it. Those were in the previous class, you saw how we arrived at ROA. Then you'll have to come up with what you call an amortization schedule, which will be able to give you interest under the lease. Will give you interest on the lease. It will give you interest on the lease. Also, from the same amortization schedule, you'll be able to get the non-current liability obligation under the lease. Non-current liability obligation under the lease. Also, you'll have to get another figure. We call it the current liability obligation. Under lease. In short, the point I'm trying to drive home, Margaret, when you see a lease question, these items should be ringing in your mind. How do I arrive at them? These items should actually be ringing in your mind. How do you normally get the right of use of the asset? How will I be able to compute the depreciation? How will I be able to arrive at the interest on the lease? How will I be able to arrive at the non-current liability obligation? Of course, from what we did in our previous class, I told you, for these 3, you'll have to come up with what we call an amortization schedule. You'll have to come up with an amortization schedule. So from that schedule, you'll be able to identify interest for each and every period. You'll have to identify the non-current liability obligation for each and every period. You'll have to identify the current liability obligation under lease for each and every period. And of course, this one will actually go to the P&L account or the income statement. This one will go to the statement of financial position as an non-current asset. These 2 will actually go to the statement of financial position as liabilities. Statement of financial position as what? As liabilities in the books of the lessee. You must actually be comprehending, understanding what is happening. So when you see a lease question, anything having to be mentioned about leases in the books of the lessee, as a financial reporting student, these items should be ringing in your mind. How will I be able to get the right of use of the asset? How will I be able to compute the depreciation? How will I be able to get the interest on the lease? How will I be able to get the NCL and CL obligations under the lease? And therefore, today, I want us now we look at how you account for leases. I can see Marvin says the board is not clear. The board should be far much better. It should be far much better. I can see that CIFA even says yes. It is not clear. It is not clear. Confirm. Confirm. It should be far much better. I can be able to see how your screen should be appearing. How your screen should be appearing. It should be clear. It should be clear. Unless you haven't expanded your screen, if you are using your phone, it should be clear. It should be clear. Because I can see how your screen is having to appear at your end. I can see how it is having to appear at your end. So today I want us now we look at how you account for leases, where the lease payments are having to be done in advance. Accounting for leases, where the lease payments are having to be done in advance. So you can be able to write this. You can be able to write this. You can be able to write this. Accounting for leases, where the lease payments are having to be done in advance. You write this. Accounting for lease payments in advance. You write that accounting for lease payments in advance. Then you open this question. I exactly shared in the past paper on the group. You open this question, November 2016, question number 2. Go to this question, November 2016, question number 2. Open that particular question. Once you've been able to open it, you let me know. November 2016, question number 2. I exactly shared it on the group. If you are there, you say yes, we are there. You say yes, we are there, so that we can be able to start immediately. November 2016, question number 2. November 2016, question number 2. If you are there, you say yes. Make sure when you come to the class, you have a past paper. I can tell you, in a fact, each and every lesson we are going to be referring to past papers. You must be having a bunch of the past papers. To be far much better, you can print them and be working with them around like a dictionary. You see how the dictionary was actually very important in an English lesson in high school. That's how the past papers are very essential in the studies for your financial reporting as a unit. Yes, we are there. Can be able to see. Oluwahasi, Brian says, yes, we are there. I can see Mercy says, yes, we are there. So on that question, we're not going to look at the entire question. Look at note number 3, additional information number 3. Note number 3 or additional information number 3. So go to additional information number 3. You're not going to look at the entire question, but I want to take you through that additional information number 3. That additional information number 3. So this is how it actually reads. It says, so of course, these are entities known as Peak Limited. It says, on 1st of November 2015, Peak Limited entered into a 5-year lease agreement for an item of plant. This item had an estimated useful life of 5 years. The annual rent of which was payable in advance with the effect from 1st of November 2015 was 132 million. The fair value of the plant is 552 million and the implicit interest rate is 10% per annum. It's 10% per annum. So of course, because the question is not there, but ideally I've told you when you see a question concerning leases in the past papers. So they're actually having to call upon you to come up with the right of use of the asset, the interest under the lease, the non-current liability obligation, and the current liability obligation. Of course, on the right of use of the asset, also you have to compute what? Depreciation. You have to compute depreciation. So if you look at what you're having to be told, on 1st of November 2015, Peak Limited entered into a 5-year lease agreement for an item of plant. This item had a useful life of 5 years. Of course, also the lease period was actually how many years? 5. The annual rent which was payable in advance. You see, we are looking at how you account for leases in advance. Remember, in our previous illustration, we were looking at how you account for leases where the payments are having to be done in arrears. You know, I'm having to say in advance and arrears, it might seem something very simple. But But this is what I'm having to mean. We need to understand when we say arrears. So you see, when you talk about lease payments having to be done in arrears, it simply means the rental payment, like if you're having to pay the landlord, you're not paying in advance. You are paying at the end of the period. For example, if you commence the lease on 1st of January 2026, you won't pay on these dates. You likely pay on 31st of December the rental payments. You know what it means by a lease? Ni kurent, kupewa asset fee hapo unaendelea kutumia. So you are paying rental payments. What do you mean by having to pay the rental payments in arrears? You are paying at the end of each and every period, 31st of December. In advance, before you start using on first, in advance, before you start having to use, you have to pay on that first date. Like how we said your rent is normally paid. Before you start using the house for the landlord, he'll tell you to pay the rent for the first month. The rental payments are having to come in advance. It might seem a simple term, but you might get confused this entire class when I just mentioned advance and in arrears. That's what we mean by advance and in arrears. So in our previous question, we were looking at a situation where the lessee is having to make the rental payments when at the end of the period. And you saw how we accounted for it. But in our question today, we're going to look at a situation where the lessee is not having to make the rental payments in arrears or at the end of the period. Before he commences to use the asset, he has to make the first rental payment. And this is what this question is actually having to do at test here. That statement is having to do at test. And of course, you're going to see how Big Limited will account for this kind of a lease on this asset in its what? Books of account. That's you're having to put it in what? In advance. We're having to call it what? In advance. So of course, the similar steps will apply like the ones we use to account for lease payments in arrears. So the first step, what you need to be able to do or actually compute it, you'll actually compute step number 1. You have to remember this step. Step number 1, computes the lease, the fair value of the lease liability. Compute the fair value. Compute the fair value of the lease liability. 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 How do we say you actually do this one? You take the rental payments. Rental payments. Multiply by the present value interest factor of annuity at a particular rate. So of course, those who are having to do financial management, you've already started looking at time value of money. You've actually been taught something to do with what? Discounting and annuity. And of course, there's a very famous formula your teacher is having to quote there. It's having to say 1 minus 1 plus R raised to negative N over R. So these are discounting factor for what? 1 annuity. What is an annuity? Payments, similar payments having to be received periodically. Similar payments having to be received what? Periodically. And this is the master formula. This is the master formula for getting fair value of the lease liability. These are you are called upon under IFRS number 16. You compute the fair value of the lease liability. In short, you are computing what is the value of this liability to use this asset. In totality, as we are commencing the lease on 1st of November, and tukianza 1st of November 2015, the fair value ya what is a liability? Daily. Ideally, hii daily value yake ni ngapi vile tunaanza? The fair value of the lease liability. Of course, the rental payments are having to be received in future. But now you have to look at this liability today. How much will it be? A shilling today is worth more than a shilling tomorrow. And therefore, those rental payments you likely end up having to pay in future. You have to discount them and put them in the present on the first day. You are commencing the lease. You are commencing the lease. We have to know in reality the real liability. You know, 1,000 shillings today might not be the same 1,000 shillings 5 years from now. The value would have actually reduced. And therefore, if it happens, these 1,000 shillings are having to be paid after 5 years, the value won't be the same. That's what you are calculating here. Realistically, this liability today when we are starting, although we'll make the rental payments in future, realistically today, what is the value of this liability? This is what you're having to compute here. And it's very simple. This is the master formula. It won't change. It will just remain rental payments multiplied by this factor here. This factor here. And we can be able to compute it. Because you've been told the rental payments. You are told that this is what you're having to be told. Peak Limited entered into a 5-year lease agreement for an item of land. This item had an estimated useful life of 5 years. The annual rental payments, which are payable in advance, with effect from 1st of November, from this date, in advance, from this date, they are paying rental payments of how much? 132 million. So you'll say, because we are going to do our workings, we can put shillings in thousands like that. You can put shillings in thousands like that. So you can be able to say 132 million multiplied by 1 minus 1 plus, what is the rate? The rate you've been given is actually how much? 10%. You say 0.1, 0.1 over 0.1. So how many years are they? They are actually 5. They are actually 5. How many years are they? They are actually 5. But now here is where you have to be very keen. Listen and listen very keenly. This is where you have to be very keen. This is where you have to be very keen. So you said when you talk about N here, it means what? The number of periods or what? For years. And this is also where it is a bit different when you actually compare with the one what in areas. You have to be very keen here. Listen and listen very keenly. Here under the N, it won't be 5. It will be 4. It won't be 5. It will likely be 4. It will 4. So on these periods that you'll be given 5, you deduct 1. Because already 1 payment has already been received. So the rate of payments that are yet to be received is either 4 than Zambele. 4 Zambele. The one in areas, you see, you are receiving the rate of payments at the end of the period. This one, already the first payment is in the present. Present interest factor. Already the first payment 132, already on the present on the first day. What are we having to calculate to be in present? The remaining 4 payments, they start in future. So when you are calculating the fair value of the stability under advance payments, the N here is always 1 period less. Is always 1 period less. And therefore you say minus 4. When you calculate, what are you having to get? There's something you are going to get. There's something you are going to get. What are you getting? When you calculate, what are you getting? 132,000 multiplied by that factor is a figure you're going to get. 132,000 multiplied by that factor is a figure you're going to get. You need to use your calculator. You need to use your calculator. What are you getting? You need to use your calculator. What are you getting? What are you getting? What are you getting? You need to move with a bit of speed. FR students are usually very fast. They're usually very fast. Wanagonga chap chap. I can see user says, of course, multiply. User complete the mathematics. Multiply by 132. Complete the mathematics. Complete the mathematics, user. 418. Actually, 418, 426.8. 418, 426.8. I can say 418, 422. So just multiply with the complete factor. I want to get like almost an exact figure. Almost like an exact figure. I can say 418, 418, 422.24. 418, 422, 238. Yes. 418, 422.24. So no problem. 418, 422.4. That's what you're having to get. 418, 422.24. Yes. 418, 422.24. That's what you are getting as what? As the fair value of what? Of the lease liability. As the fair value of the lease liability. Suppose there's something the examiner has actually been able to give you there. He's having to call it what? The fair value of the asset, or the fair value of what? Of the plant. The fair value of the plant. Of course, I told you, once you've already been able to compute the fair value of the lease liability, the next step you are supposed to be able to calculate what we call what? The right of use of asset. The right of use of what? Of the asset. Just a minute. So we can have the figure as what? 418,422.24. 418,422.24. So, and therefore we say step number two, we say step number two, you have to do what? Compute or calculate what? The right of use of what? The assets. Calculate, compute the right of use of assets, which you call what? ROA. If ever they use the term what? ROA is the abbreviation of this. ROA. And it's just the same. You see that formula I gave you? I told you have to take what? The fair value of the lease liability. Fair value of this liability. The one you would have actually calculated above there. You see this one, you've already been able to calculate above here, the fair value of the lease liability. The fair value of the lease liability. Then you have what figure? It is actually 422.24. Let's just have it like that. Then we say we need to add on any advance payment. And advance payment. Was there any advance payment? Yes, indeed it was there. There was an advance payment because you are told that initially before they started the lease, they actually paid how much? They actually paid. I can see you are able to, you're not able to see there. Let me see whether I can be able to adjust this a bit. Whether you'll be able to see there, no problem. So let's see what will happen. So we say this is how you calculate it. You first of all take the fair value of what? Of the lease liability, what you would have calculated in step number one. You add on any advance payment. What was the advance payment? 132. You can see before they commence the lease, the first payment had been received. That's why you're only having to discount the 4 that are remaining in future. So you'll have to come here 132. 132,000. Is there any initial direct cost? We said if it is there, you have to add it here. But it isn't there. Any initial direct cost, we simply mean that before this lease actually commenced, they might have incurred certain what costs. For example, maybe they involved a lawyer. So they had to pay what? A legal fee to craft the agreement of the lease. That is what? An initial direct cost. But we haven't been told. It is not there. Let's not start having to assume something that is not there. Let's just work with what we've been given. Already we have the fair value of the lease liability computed. Also in the question they have told us what had already been paid in advance as the lease actually commenced was the first rental payment. So you'll be able to put here how much? 132,000. When you put there, you'll get a very nice figure. And of course, I'm going to explain something about the figure. You'll get how much? This one is 24. This one is 550. It will be 550. You'll get 554.22.24. 554.22.24. If I'm correct. It's 550. 554.22.24. If you are supposed to round it off, there's no, you don't necessarily have to round it off. Even if you round off, you shouldn't actually be far away from the answer. You shouldn't be far away from the answer. Even if you round off, you shouldn't actually be far away from what? From the answer. But the best way, don't round it off. Just multiply directly with what you've been given here. You'll get the most appropriate figure. Because you see, rounding off, when you round off, you're not getting the exact figure. But what the calculator has given you is the most correct figure. That's why I was having to tell you, just multiply directly without having to round off. What the calculator has given you is the most exact figure. When you round off, now you are making it even to be wrong. That's why I was having to advise for this TV, just use what exactly you put in the calculator. Because even when you round off, in fact, you're having to make it wrong because the rounding off is not the exact figure. So what you have in the calculator is the most appropriate. Now multiply with what? 132. That is the best option. It is the best option. But of course, if you round off, there's no harm because you shouldn't actually be so much far away from the answer. You shouldn't be far away from what? From the answer. So you'll be able to get what? 554.22.24. So this now happens to be what? The right of use of the asset. Right of use of the assets. But now you see what the examiner actually gave you. And so the examiner actually told you there. The fair value of the plant is actually 552. 552. So what he did, he just ended up having to round it off and actually gave you what the figure. He gave you this particular figure here. But if it happens, he hadn't actually given you the fair value of the asset. Then this is how you could have actually been able to arrive at what the fair value of the asset. So you can be able to call this one what the right of use of the asset or the fair value of asset. Right of use of the asset or fair value of this particular plant item. But what the examiner did, he actually rounded off and actually gave you what the figure, which is an amount of what 552 billion. But it happens, the examiner hadn't given you the requirements of the standard requires that. For you to get this fair value of the asset, go through this particular process here. Get the fair value of the lease liability first of all. Then calculate the right of use of the asset. That is the value of the asset that will likely be reported in the books of accounts of the leasing. How do you get it? You normally take the fair value of the lease liability, you compute it, you add on any advance payment, you add on any initial direct cost, you'll be able to get the value of that asset. But here the examiner actually rounded off and actually gave you what the figure. But you see, the point I want you to be able to get is to understand what does IFRS 16 provide, or how we are supposed to be able to do what calculate the value of what the asset. And this is how you actually calculate it. So I actually ignored what the examiner did what provided. What the examiner did what provided there. And therefore I took you through what the right process to get the fair value of the asset. So if it happens, maybe the examiner hides it, it doesn't provide it for you. This is how you can be able to arrive at it. And you can actually be able to calculate it. So he actually did calculate it, but now he gave you what a rounded off figure, just to be able to give you what the fair value of the asset. The fair value of the asset. And therefore, that will actually be what the steps you'll be able to follow to arrive at what the fair value of the asset, or what we call the right of use of the asset. The right of use of what of the asset, the right of use of the asset. Hope we've been able to capture up to here because I want to wrap and then we move on towards the other steps. So let's move on to step number 3. Step number 3, I actually told you are supposed to calculate the depreciation on the right of use of the assets or on the value of the assets. Depreciation on the right of use of the assets. Depreciation on the right of use of the assets. Depreciation on the right of use of the asset. On the right of use of what? Of the asset. So what will happen here? Go to step number 3. Step number 3. You'll have to do what? Compute the depreciation on the right of over asset or the fair value of the assets. Which is the fair value of the assets, which is the fair value of what? Of the asset, the fair value of the asset. So you see, this is what you've already been able to compute. Computed, what's our figure there, which is 550. So which one are we going to use as right of use of the asset? As per the requirements of this particular exam, you'll likely be able to use what? 552. Because you've already been given. But I was having to take you through that step. In any case, the examiner didn't provide it. This is how you could have actually been able to compute it. Take note, the examiner rounded off and actually gave you what? A figure. He didn't want you to do what? To calculate it. But you see, what I want you to understand in this lesson is for you to know how you arrive at those figures. Hope you are getting what I'm having to inform you. I want you to understand the steps, how you arrive at those figures. So the examiner here didn't actually want you to do what? Calculate that fair value of the asset. So he actually provided it. But I'm telling you, sometimes he can be able to hide it. He wouldn't provide it. So what he did, he just rounded up and gave you what? A close figure. And it's not the only example you're going to look at. You'll be able to see even in the other questions. He just gives you the figure. But now if you use the right process, this is how you're supposed to arrive at it. This is how you're supposed to do what? To arrive at it. And therefore, for this particular specific question, we'll be able to use what he has actually already been able to provide for us. As what? The right of use of the asset, or what? The fair value of what? Of the asset. Let's use 552 million as he has already been able to provide it what? For us. And therefore, if you are calculating the depreciation here, we'll say depreciation is equals to, we said you will take the right of use of the asset, or that fair value of the asset, which is the fair value of the asset, you divide by You said you can take the useful life, or you take what? The lease period. You take the lease period. You take the lease period. But there's something I already told you. You see, like in our question here, they have given us similar useful life. This one is 5. This one is also 5. This one is actually also what? 5. This one is 5. This one is also 5. So we just pick 5. But sometimes they can tell you that the useful life, they can tell you the useful life is maybe 7 years. And then they tell you the lease period is actually 4 years. If they happen to do like that, you take the lower. Take the lower, this one, or just take the lease period. Take the lower or take what? The lease period as the one you'll be able to use to calculate what? Depreciation on right of use of the asset. So if it happens that W, for example, told us the useful life of this plant item is 7 years and the lease period is 4 years, would have taken the lease period. Would have taken the lease period. But in most of the questions, you realize that the useful life will be similar to the lease period. Like in our question here, it is the same. It is exactly what they say. And then we'll just say the depreciation here will likely be 552,000 divided by 5. What are you having to get? 552 million. Actually, your figures you are using what? Thousands. That's why I'm saying 552,000. Already we've reduced that. So it will be 552,000 divided by 5. So how much are you getting? You'll get 110 something. 110, 400. You'll be able to get 110, 400. 110, 400 like that. So that is our what? Depreciation. Of course, I shouldn't explain depreciation. You understand it. It is the value that is having to be lost on these assets that has actually been listed each and every year. And therefore, it means when you likely be reporting the right of use of the asset in our statement of financial position, we'll have to reduce that right of use of the asset by 110, 400 for the first year, second year, third year, fourth year, until the fifth year. Well, now the value will likely be what? Be 0. It will likely be 0 like that. And therefore, that is what? The depreciation. That's how you get what? The depreciation. Then we said, once you've already been able to compute the depreciation, there are 3 remaining key figures you have to get under a lease question. Interest under the lease, the non-current liability obligation, and the current liability obligation. And how do you get this one? We say you use what? The amortization schedule. So it means in our next step, to get those 3 figures, we have to come up with what? The amortization schedule. And then we can be able to write step number 4. Let's move to step number 4. We come up with what? Our amortization schedule. Those figures, you'll be able to get them from the amortization schedule. It will be very easy to get them from the amortization schedule. From the amortization schedule. Be able to get them from the amortization schedule. So you'll be able to say step number 4. Step number 4. We come up with what? The amortization schedule. So from the schedule, we'll be able to identify interest under the lease, which will be an expense. We'll be able to identify the non-current liability and current liability obligations. So take note, I've actually told you one of the differences that is actually there where lease payments are having to be done in arrears and in advance. It is where you're using that PVFA. So the PVFA for advance, we eliminate 1 period. We don't consider it. If it is 5 years, we use 4 periods. If it is 3 years, we use 2 periods. Because already the first payment is already in the present. So we don't discount it. Because you're having to commence the lease as you make the first rental payment. That one, don't discount it. You'll only discount the ones in future. In our question here, already the first 132,000 had already been received. What has not been received are the remaining 4. Those ones are the ones you discount when you're having to calculate what the fair value of the lease liability. So that's where the difference is. Also, when you compare with what? The one in arrears. Because the one in arrears, you consider all the periods. Like if our lease here was actually having to be paid in arrears, we would have used 5 years. Because all of them, the 5 payments will be received in future. 31st of the year, 31st of the year, like that in future. And therefore, all of them, you have to make them in present. you have to discount them when you're getting what the fair value of the lease liability. That's where the difference is when you're also having to compare with arrears and the one actually also what in advance. Then also the difference comes here under the schedule. The schedule for this one is actually a bit different, and this is how you'll be able to present it. Just a small difference. You'll first start with what? The period. Start with the period, then you go to the balance, brought down. This is the balance of the start of the period, each and every period under the lease liability. The balance brought down. Then here, the payments are having to be done immediately at the start of the period. So the payment comes immediately here. Payment comes immediately where? At the start of, after the start of the period has just started, you make what? The payment. Listen very keenly. Check on your network. Check on your network.
Periodical.
And see, we can't hear. What about now? Are you able to hear? Confirm. Stephen Musioki, I can see you saying yes. Margaret says yes. Mercy Ouma, confirm. Mercy confirm. Mercy Ouma. Latifa says yes. Mercy Ouma says yes. Marvin Mose. But we can't see well. You should be able to see well. Repeat from balance brought down. So from here. So I was having to say that with the amortization schedule, this is also where another difference arises when you compare with what? The lease payments are having to be done in arrears. For an amortization schedule where the payments are having to be done in advance, it looks like this. You likely start with the period, then you indicate the balance brought down. This balance brought down is the lease liability at the start of each and every period. It's the balance brought down. Then now that the payments are having to be done in advance, the payments are having to be done in what? In advance. The payment comes immediately. See, like the first one comes what? Actually immediately. The payments come what? Immediately. Then once you make the payment, there'll be a balance due that you haven't settled by the end of the period. When it comes to the end of the period, tunaweka interest. Tunachapa interest for your liability. We put an interest. Then now after we put an interest, now comes a balance carried down. We have to accumulate that interest, then we carry down that liability, we bring it here. We repeat the same process. When we bring that liability for the previous year, it opens here, we pay again immediately a rental payment here. It actually reduces and we have a balance too. So it goes on like that. So the schedule here is actually a bit different. For those who are in the previous class, you can take note of that. The schedule you actually used in what? In arrears one was actually different from this one. And this is how you present this one to be able to get what? The most accurate or correct what? Figures. And then for the first figure, you'll be able to start with here is the lease liability. The board is very blurry. Out there, it should be clear there. It is okay now. It's okay now. So what you'll be able to start with here is the lease liability at the start. And here also must you have to be very keen. You see, we are talking about a liability. A liability ni pesa zenye hujalipa manze. Ni pesa zenye hujafanya nini hujalipa on this asset. And of course, the fair value of the asset, you see the fair value of the asset, the fair value of the asset is actually 552 million. Or the fair value of the lease liability is actually how much? 552 million. But already when you are commencing, you've already paid 132. You've already paid how much? 132,000. And therefore the liability when you are starting, it simply means exactly how much? 420,000. So don't start with 552 here because that's what the students will actually make a mistake. When you are starting the lease on 1st of November 2015, immediately ushalipa 130. So you see daily on that lease. What is daily is what you've not paid, and therefore we'll actually commence here with how much? 420,000. Hope you've been able to understand what is a liability, what you've not settled. The totality of this fair value of the lease liability is exactly what? 552 million. But you've already paid on the first day 132. So here utaanza nayo kama liability. Already ushailipa. Already ushailipa. So that means you'll start with what? 420,000 or 420 million as having to do what? The liability. Then also on the payments here, be very keen. Don't put that 132 because you've already accounted for it here. Ushai reduce up and down. So don't account for it. So all the other payments will likely be received. 132 for the remaining 4. 132,000. B inaenda to equal 132,000. These payments are just constant. They are the rental payments, 132,000. Then when you pay, this one, if you pay nil, it simply means it remains here 420,000 because you paid nil. When you place 10% on it, it comes to 42,000. And therefore, when you add the two, by the time you are coming to the end of the year, the liability is actually 462,000. You open it here, 462,000. Unaweka 132. Inakuja 330. If it comes to 330, 330 or how much? 420,000 minus 132, 330. Comes to 330 because you paid 132. You opened on the first day of the next year. Here, you paid 132 immediately. By the time you are coming to the end of the year, the balance due is 330. But now, unachapa interest on that balance due 33,000. When you add the two, by the time you are closing the year, the liability comes to 363,000. You open again the next year, 363,000 with that liability. You chapa 132 on it. You pay immediately 132,000 on it. You will remain with what? 231,000. 231,000. You place interest on it. It's like a loan. You place interest on it. It should be 23,100. like that. You add, by the time you are closing this year, you were at the end of the year, and the liability itself was 231. But now you place interest of 10% on it. So it comes to 253, 254, 254, 100. 254, 100. You open the next year again, 254, 100 with that liability. You pay immediately 132. So you will take 254, 100 minus 132. You get how much? 122, 100. 122, 100. 122, 100. You place interest on it. The interest is 12,210. 10% of this, I don't have to ask you that one. I can see 10% of that is 12,210. You add on it, comes to 234, 134 something. 134, 310. 134, 310. 134, 310. You open the final year. 134, 310. You pay 132,000. You remain with something there. The balance due will be 2,000 and something. 2,310. 2,310. Ideally, you are supposed to arrive at 0 here. The reason why we are not having to get 0 is because of the confusion of the examiner. They are rounding off to 552. When this 552 obvious, but if it happens, you used hours 550. If you used hours 550 here, then when you do it properly, you should be able to arrive. This one, these liabilities by the end of the period should be able to arrive at 0. This one's why there's still a figure here is because of the rounding off effect of the examiner. Instead of having to use the correct fair value of the lease liability, he actually rounded off to 552. That's where there is something having to remain here. But if it happens, you do it properly. Just use hours, that is 550 minus this 132, get the lease liability almost before 18. Before 18 here. When you do it properly now, you should be able to arrive at 0. But now that the examiner rounded off, the figure here we are not having to arrive at 0. There's some amount that is actually still having to remain. 23, 10. But ideally, that's how you actually do what? Present your amortization schedule. We present our amortization schedule. So you've been able to understand it. So the payments here, you don't put it because you've already paid it. But the other payments, you'll make them in the schedule. Then you just go flow with the schedule. After that, you should just be able to flow. This one minus this for 20. Interest on it, 42. Add 462. Bring it here, 462. Minus 132, 330. Chamber interest on the 330 balance due, it will be 33,000. You add, you get the liability by the end of the period. You open it, you reach the next period. You pay 132, you remain with 231. You place it, 10% interest on this is 23,100. Go on like that, like that, like that, like that. But of course, our main purpose as why we're having to come up with this schedule was for us to identify what? The interest for each and every period, to identify the current liability obligation, to identify what the current liability obligation. That was our main what? Purpose of coming up with what? The schedule. Coming up with what? The schedule. I can see patient says poly. Now repeated like the 4 or 3 times the schedule again. Hope you've already been able to write it. Can we proceed or not yet? Can we proceed or not yet? Give us questions in the past papers for practice, please. Maswali unaenda kuzifanya, so just relax. You first of all grasp the concept. Grasp the concept. Maswali unaenda kuzifanya, zinaenda kuwa mingi sana. Mingi sana. Can we proceed? I want to go up to the end before I start giving you questions now. And we can proceed then. Yes, we can proceed. So that's how you present the schedule. So this one is why we came up with the schedule was for us to get what? The interest, non-current liability obligation, and the current liability obligation under the lease. And the interest you can easily be able to identify it because you can see it is here. For this first year, it is actually what? 42. For this second year, it is 33. For this third year, it is 23,100. For this fourth year, is actually how much? 12,210. This one won't be here because I've told you ideally is supposed to be 0 here. Won't actually be there. So you'll be able to see the interest for the first year is 42. For this second year is 33. For this one is 23,100. For this one is 12,210. 12,210. And therefore, you have to now identify what? The non-current liability obligation. So you can be able to identify That's how you identify what the non-current liability obligation. You need to write this, the non-current liability obligation. How do you identify it? You check the balance due. You'll be able to take the balance due. Balance due from the subsequent. You can say the subsequent or maybe second year. From the subsequent year, the subsequent year, or can put just say it. I like having to say from the second year. I like having to say from the second year. You take the balance due from the second year. Remember the one for the arrears, who are taking the balance carried down. But for the one in advance, to get the current liability obligation, you take the balance due from the second year. And how do you identify the balance due? It's very easy from the schedule. You see, if you want to know the non-current liability under this is in after more than a year. For this first year here, you'll pick this amount. You are after more than what? A year. What is an non-current liability? The one you won't be able to settle this year. And therefore, for this first year here, we're able to pick this particular amount here. It will be 330. But for this second year here, it will be this one here. For this fourth year here, in fact, it will be 0, supposed to be 0. So there are these ones here. These ones here. So you want to get for the first year, it will be which amount? It will likely be this one, because you are picking from what? The subsequent or the second year. For the first year, it will likely be 330,000. That will be the liability, or the amount due under this this liability. For the second year, you want to get for the second year, it means you'll go to pick the one for what? For the third year. So this one for second year here, you'll pick this amount here. Because it won't be paid in this year, it will be paid in Kazambe. It's about 231,000. And then for the very final year, third year, it will likely be 12,210. 12,210. So those are what? The non-current liability obligations. Yani, if unataka ushike, my friend, hii statement. How do you get a non-current liability obligation? Under lease payments in advance, you take the balance due from the second year or the subsequent year. So ukitaka kupata hii first year, kuja uchukue hii. Ukitaka kupata hii second year from the schedule, kuja uchukue hii. Ukitaka kupata hii third year, kuja uchukue like that. Uchukue hii like that. Actually, this one is not supposed to. It's supposed to be 122 to 100. Sorry about that. It's this one like that. 122, 100. I was speaking the interest, but it's supposed to be this one. 122, 100. Now we can now be able to identify what? The current liability obligation. So how do you get the current liability obligation? The current liability obligation. I don't know where I can be able to write. Let me write it here. Let me write it here. So the current liability obligation. So we want to get now the second that you've already been able to identify this. We've identified this. Now what is remaining is the current liability obligation. So you'll say, how do you identify the current? The CL obligation. CL obligation. How do you identify the CL obligation? The CL obligation. How do you identify the CL obligation? For the CL obligation, you pick the payment. You like to pick up the payments from the second year. You pick the payments that were done. Payments from the second contract. Yeah, you also pick the payments from what? From the second year. Because the payments are this one, that's one, that's that. So this first year they made, in fact, ideally on the first day they made 130. But now if you are getting it from the schedule, just pick these ones, 132, 132, 132, like that. So for this first year, it will likely be 132. This one it will likely be 132, this one will likely be 132, this one will likely be 132. Those will be what? The short-term liabilities they're able to settle. So I think before we move to the next year, watakuwa wamelipa 132 kwanza for your liability. Before we move to the next year again, wanalipa 132 immediately. Before we move to the next year, wanalipa tena 132 immediately. So there will be 4 subsequent current liabilities that they'll likely be able to do what settle on this particular what this. So if you're having to look for the current liability obligation, pick the payments from the schedule from the second year. Payments are these ones from this policy. So it means they likely be a constant figure, constant first year to fourth year, an amount of how much? 132,000. Because this will likely be for this, this for this, this for this, this for this. So how do you get the current liability obligation? Pick the payment. This is the statement I want you to remember. Pick the payments from the second year. The payments from what? From the second year. So for the first year, you'll pick this amount. For the second year, you'll pick this amount. This is the third year. For this one, you'll pick this amount. For this one, you'll end up having to pick what? This amount. And that's how you identify what? The current liability obligation from what? From the schedule. From the schedule. So master these statements here. Those goes also do what? Master this one. So that when you come up with the schedule, you'll easily be able to know how you'll be able to extract the non-current liability obligation and the current liability obligation. So the interest you just pick because it is already in each and every year. Just pick it in the exact year it is in. The interest you actually pick it the way it is like that. Then once you've already been able to prepare this one now, the very final step, you have to come up with what we call the extracts of the statements. That is the statement of financial position and the statement of income. So you can be able to see the extracts, but before that, you can be able to have a break. Let's have a break of like 5 minutes. Or we've already written this. Because I want now, when we come back, we look at the very final step, which is to come up with the extracts of the statements of LSC. The extracts of the statements of LSC. The extracts of the statements of LSC. So we can look at step number 5. Extracts. So let's get with this. Of LSC. But before that, we can be able to have a break. Let's have a break of like 5 minutes, then we come back. Yeah, so we can proceed. We can proceed. Confirm whether we can continue now. Can we proceed or we can go to sleep? Should we go to sleep or we should continue? Confirm whether we can proceed. I can see Faith says yes. Steve-O, what about Steve-O? Steve-O, can we proceed? Steve-O, can you proceed? Steve-O, Steve-O. Steve-O, can we proceed? Can see people are saying yes, proceed. So we can now come up with the extracts, how Peak Limited would have actually presented or accounted for the lease on this plant in their books of accounts, because Peak Limited is the lessee. It's the one who was having to do what lease the asset, And therefore, assuming we are coming up with the entire income statement, we are not going to look at the entire question. I just told you we are focusing on additional information number 2, which is coming from the topic of what leases. And actually, this is how the examiner tests. He actually tests it like this. He puts it like an additional information somewhere. And then you have to really be able to understand, how will I be able to approach this additional information? It means you must actually be very able to understand, how do we account for leases in the books of accounts? Of course, you'll be able to look at published financial statements later on. And we're going to look at a number of questions. Utaona ameweka kwa kitu ka leases. So unajua kishaiweka kama additional information number 2, examiner ashajua ametest on what leases, which is under topic number 1. Under assets and actually what liabilities. He has this tendency of testing it like this. He might bring a standalone question, like the question we did for one in arrears was a standalone question. He might bring it under what we call public financial statements as an additional information. So ukiona hapo kwa additional information, don't start having to tremble. Tell the examiner understand how you account for leases. If you took additional information, I'm going to global it properly and I'm going to get the exact figures you want me to present in the final account. And that's not what you want to present here. The final figures that would have actually been presented in the final account, which the examiner was calling upon the student to prepare under required number 8 and the required number C. So the extract, you can be able to say the income statement extract. You can say Peak Limited. You're just going to do an extract because you want to know how finally they would have presented that additional information in the final account. So Peak Limited income statement. Income statement extracts for the year ended. The year ended. Because there are 5 years. There are 5 years. The first year ends on 31st of October 2016. Exactly. For the year ended 31st of October. 31st of October. So on the 1st of November 2015. Now, the first financial year inaisha 31st of October 2016. So we have 2016. We have 2017. We have 2018. We have 2019. Then he leaves Illumination 2021 months. See 5 years. Illumination 2021 months. In Peak Limited Illumination 2021 months. And of course, we are having to present our figures in what? Shillings of thousands. We're not having to deal with stones, cows, or dogs. We are serious people. We are accountants. We deal with money. You have to indicate what you are dealing with. Shillings in thousands. Shillings in thousands. We don't deal even with little money. We are dealing with the millions of money. Millions of money. A lot of money. We are serious people, serious accountants here. Shillings in thousands. So we'll look towards the expenses with this extract that will be able to arise from this list. There are 2 expenses. One of it is depreciation. Depreciation. You calculated. It was coming to 110. Sasa unaona ile ulikuwa na calculate step number 2. Haikuwa ya bure. Imagine unakuja kuitumia hapa. Hatua tuna calculate tu ya bure. So unaona imekuja hapo 110 400 for every year. 110 400. 110 400. 110 400. 110 400. 110 400. Then kuna expense again. Who can be able to tell us the other expense? There's another expense. Who can be able to tell us the other expense? Which is the other expense? At least you should be able to participate. Let me not just shout here on the board. I can see you are saying what? Interest. You are saying interest? Yes. Interest. Very brilliant there. Very brilliant there. For 2020 is not there. It is supposed to be 2020. It is supposed to be 2020. I can see my friend is very alert. He's actually having to correct. This is what I'm having to say. You need to participate. You need to participate. Sio ni mwalimu ana shout tu hapo mbele. Sio ana shout akisema ni mwalimu naye anapenda kushout. So it's supposed to be what 2020 and correct. I can see people are seeing. You are at least following what is happening. The other experts I can see brilliantly told me exactly what interest. Interest tumepata tunaona ile tulipata by amortization schedule. Imagine hatukuwa tunafanya hiyo schedule hivyo tu. You can see we've got an interest for each and every year. Ya kwanza ilikuwa 42,000. 42,000. Ya pili ilikuwa 33,000. Ya tatu ilikuwa 23,100. Wangapi 23? 123. 100. Ya mwisho ilikuwa 12 to 10. 12 to 10. 12 to 10. Ya mwisho niliwaambia itakuwa kwa sababu hapo liability itakuwa imeisha. Mwisho itakuwa 12 to 10. 12 to 10. Imagine tumemaliza hii extract. Tumemaliza hii mambo yake. We already finished the story about this extract. We already finished the story about this one. So this one is 110,400 also up to the final year. So every year it is losing 110,400, 110,400, 110,400, 110,400, 110,400 like that. Ushamaliza hiyo story hiyo extractor. Kuna ukishafanya schedule na hizo calculations zingine story inaanza kuwa rahisi. Hope you are through because I'm going to wrap it off. Wrapping it off so that we can be able to see the statement of financial position extract. Let's see the statement of financial position extracts. It means when they are presenting the final, they have to account for those interest and of course those depreciations for each and every year on the right of use of the assets. Now, we can now look at the statement of financial position extract. Take limited statement of financial position extracts. This is what it is as at not by the year ended as at 31st. December. October is October. So you have 2016, 2017, 2018, 2019, 2020, 2020 like that. You said we are what serious people. We deal with what serious money, shillings, thousands. Serious money, not little money, my friend. Not little money. Lot of money. So you have to indicate what you are dealing with. You're not dealing with points, dogs, or cows, but it's shillings in thousands. Indicates. Not dogs, stones, or cows, but this is money, serious money. So you have to indicate that. Then you say, you start with non-current assets. Non-current assets. You start with what? Non-current asset. The first non-current asset, row 1. You see that row we are shouting about? That row we are shouting about, they only calculated in step number 2. That 552,000, it comes here. 552,000. Then you consider what depreciation on it. The depreciation on it is what you is there 110, 400. See 110, 400. For this year, it will be how much? It is supposed to be accumulated. Right? Accumulated like this. Accumulated depreciation. So for the first is 110, 400. For the second year. What is the accumulated? What is the accumulated for second year? 220,800. What about for third year? You need to add on another 110 for an accumulated. Upper initial 110. By this time, it will be measured 220,800. For the third year, you need to add on another one. Add on another one. 331, 200. Very correct. Then for the fourth year, add on another 10 in accumulated. It is being accumulated until this asset becomes zero. 331, 200 plus 110, 440, 441, 441, 600. The last one I don't have to ask you. Are we together now? Confirm whether we are together. Imoso. Are we together, Margaret? Mercy. When MC Faith says okay. Stephen, no sound only. What do you mean by sound only? You can't see the video or what is happening. I can see on the screen, you should be seeing the video. The board is not clear. The board is not clear.